Hey traders, in today's video we're going to discover how to consistently earn $500 per day by trading a single, powerful pattern. Let's jump right in. The pattern we'll focus on is called the PRC pattern. So what is the PRC pattern? It's a highly effective candlestick formation consisting of 3 consecutive bars, a power bar, a retracement bar, and a confirmation bar. This sequence often precedes a strong trend, which we can capitalize on. By identifying and trading this setup daily, you could potentially make $500 per day. In this video, you'll learn to spot this pattern, evaluate trade setups, and determine the best points for entering and exiting trades. Plus, I'll cover essential risk management techniques, because no pattern guarantees a 100% win rate. Let's get started. The PRC pattern works in either direction and must include 3 consecutive candlesticks. This pattern is effective in both bullish and bearish markets, and it's crucial to understand how it forms in each scenario. A bullish PRC pattern signals a potential upward movement in price and consists of the following 3 candlesticks. Power bar, a large-bodied bullish candle, typically green, that indicates strong upward momentum. Retracement bar, a smaller bearish candle, typically red, that represents a temporary pullback. Ideally, the retracement bar should be less than half the size of the power bar. Confirmation bar, a medium to large bullish candle that closes above the high of the retracement bar, confirming the continuation of the upward movement. Entry point, enter a buy position at the close of the confirmation bar. A bearish PRC pattern signals a potential downward movement in price and consists of the following 3 candlesticks. Power bar, a large-bodied bearish candle, typically red, that indicates strong downward momentum. Retracement bar, a smaller bullish candle, typically green, that represents a temporary pullback. Ideally, the retracement bar should be less than half the size of the power bar. Confirmation bar, a medium to large bearish candle that closes below the low of the retracement bar, confirming the continuation of the downward movement. Entry point, enter a sell position at the close of the confirmation bar. Here we see a green candle with a large body, the power bar, followed by a small red candle, our retracement bar, and another green candle closing above the retracement bar, our confirmation bar. This setup indicates a bullish PRC pattern, signaling a good long entry. Post pattern, the price trends upward nicely. Here's a red candle with a large body as the power bar, followed by a small green candle as the retracement bar, and a red candle closing below it as the confirmation bar. This setup forms a bearish PRC pattern, suggesting a short position at the close of the confirmation bar. The price then trends downward. Even if a PRC pattern forms perfectly, ignoring the broader market sentiment can lead to poor trades. Trading this pattern when the market is moving strongly up or down is very risky, as such markets tend to retrace, and you could get caught in a retracement. Always look for calm, trending markets where the movement is more stable and predictable. Avoid trading the PRC pattern during high-impact news events or in highly volatile market conditions. As you can see in this example, this is a perfect PRC pattern, but the market is moving sharply, which is considered a risky market because it can retrace at any time. Therefore, this pattern shouldn't be taken into consideration. The PRC pattern can appear in various time frames, but not all time frames are equally reliable. Trading on very short time frames like 1-minute charts can result in false signals due to market noise. The best time frames for the PRC pattern are higher time frames such as the hourly, 4 hours, and daily charts. These provide more reliable signals and reduce the chances of false positives. For example, here is a failed setup that formed on a 1-minute chart. As you can see, the pattern looked valid initially with a power bar, retracement bar, and confirmation bar. However, due to market noise and volatility on this short time frame, the trade quickly reversed and hit the stop loss, illustrating the unreliability of smaller time frames. Failing to implement proper risk management can turn a winning strategy into a losing one. Always use stop losses to protect your capital. Place your stop loss just below the power bar for a bullish pattern, or just above it for a bearish pattern. Also, ensure that your profit target is at least twice your stop loss distance to maintain a favorable risk to reward ratio. To elevate the effectiveness of the PRC pattern, integrating it with other robust strategies can lead to more reliable and profitable trades. Here are some advanced strategies to consider. Trading the PRC pattern with the trend. Trading with the trend is a fundamental approach that increases the likelihood of successful trades. We will use a 100-period simple moving average to determine the overall trend direction. Apply a 100-period simple moving average to your chart. This longer-term indicator helps identify the prevailing trend more accurately. Bullish patterns. Only look for bullish PRC patterns when the price is above the 100 simple moving average. This indicates a long-term uptrend, aligning your trades with the dominant market direction. Conversely, only consider bearish PRC patterns when the price is below the 100 simple moving average, indicating a long-term downtrend. By aligning your trades with the long-term trend, you increase the probability of success and reduce the risk of counter-trend trades. Trading the PRC pattern with support and resistance. Combining the PRC patterns with key support and resistance levels can enhance the reliability of your trades. These key levels act as barriers where price tends to reverse or consolidate, providing excellent entry and exit points. If the price bounces off a support level and forms a bullish PRC pattern, it strengthens the buy signal. Enter the trade at the confirmation bar and place your stop loss just below the retracement bar. If the price hits a resistance level and forms a bearish PRC pattern, this reinforces the sell signal. Enter at the confirmation bar and place your stop loss just above the retracement bar. Setting your profit target at twice the stop loss distance maintains maintains a favorable risk-to-reward ratio, increasing the potential profitability of your trades. Trading the PRC pattern after the breakout of a range. Trading the PRC pattern after a breakout from a ranging market can be highly effective. Ranges occur when the price oscillates between defined support and resistance levels without a clear trend. The breakout from a range often leads to strong price movements, which can be capitalized on using the PRC pattern. Look for periods where the price moves within a defined range, bounded by support and resistance levels. These can be horizontal ranges where the price consolidates before a breakout. If the price breaks out of the range while forming a PRC pattern, it often moves sharply in the breakout direction. For instance, if the price breaks above the range and forms a bullish PRC pattern, this signals a strong buy opportunity. Enter at the confirmation bar with a stop loss below the retracement bar. If the price breaks below the range and forms a bearish PRC pattern, this indicates a strong sell opportunity. Enter at the confirmation bar with a stop loss above the retracement bar. Setting a profit target at twice the distance of your stop loss ensures a healthy risk-to-reward ratio, maximizing your potential returns from these breakout trades. Now, let's move to the next strategy, PRC pattern with volume analysis. Using volume analysis can greatly improve the reliability of the PRC pattern. When the power bar forms, check for a significant increase in trading volume. This increase confirms that strong momentum is backing the move. A high volume during the power bar formation enhances the probability of a successful trade. If the retracement bar shows a decline in volume, it further confirms the pattern's reliability. Let's move to the next strategy, PRC pattern with relative strength index. Incorporating RSI can help in identifying overbought or oversold conditions. If a bullish PRC pattern forms and the RSI is below 30 indicating oversold conditions, it strengthens the buy signal. Conversely, if a bearish PRC pattern forms and the RSI is above 70 indicating overbought conditions, it reinforces the sell signal. This combination helps in filtering out false signals. Let's use the PRC pattern with Fibonacci retracement levels. Using Fibonacci retracement levels can help identify potential support and resistance areas. After identifying a PRC pattern, draw Fibonacci retracement levels from the start of the trend leading to the power bar. The key Fibonacci levels to focus on are the 50% and 61.8% retracement levels. If the retracement bar aligns with these key levels, it adds validity to the pattern. This strategy helps in setting precise entry and exit points. Implementing a solid risk management strategy is crucial when trading the PRC pattern to safeguard your capital and maximize profits. Here's a recommended risk management approach. Position sizing. Determine the appropriate position size for each trade based on your risk tolerance. A common rule is to risk only 1 to 2% of your trading capital on a single trade. Stop loss placement. Always set a stop loss order to limit potential losses. For a bullish PRC pattern, place your stop loss just below the retracement bar's low. For a bearish PRC pattern, place it just above the retracement bar's high. Take profit levels. Establish clear profit targets. A good practice is to aim for a reward to risk ratio of at least 2 to 1. This means your profit target should be at least twice the distance of your stop loss. Before entering a trade, evaluate the potential risk in the context of your overall portfolio. Avoid over-leveraging and ensure you have enough capital to withstand multiple losses. Let me share with you one of my favorite money management trading techniques, the 2 to 1 trading technique. As you know, not all your trades will go in your favor. Some will succeed and others will not, as trading is all about probabilities. But what if I told you that you could win in this game, even if your strategy works only 40% of the time? This means that even if you win only 4 trades out of 10, you can still be a winner. Let me give you an example. Let's say you risk 50 pips per trade, which is 2% of your account, and set a target of 100 pips, giving you a 2 to 1 reward to risk ratio. If you take 10 trades and lose 6, it means you have a total loss of 6 times 50 equals 300 pips. However, if you win 4 trades, your total gain is 4 times 100 equals 400 pips. So even in your worst scenarios, you will make money. So there you have it. We've covered everything you need to know about the PRC pattern. If you found this video helpful, make sure to hit the like button to let us know. We're always eager to hear your thoughts, so drop a comment below if you have any questions or if there's a topic you'd like us to cover in future videos. And of course, don't forget to subscribe to the channel and turn on notifications